let us have understanding of the next question. Along with that, so the concept of the application of the stock index futures. So understanding that now. Dear students, we understand it's always say some transactions are inserted or some transactions are like created with certain purposes. Of course, that purpose may not be the only purpose with which that transaction is used, and it may be used for certain other purposes also. For example, the forward contract to be entered upon, like was say entered upon, that is that forward contract concept was in had an inception that if at all I have exported goods, I am going to receive the foreign currency and I am expecting that say my domestic currency will appreciate, the foreign currency will depreciate, then in that case I will enter into the forward contract for the purpose of hedging. So hedging was basically the purpose with which the forward contract was introduced. But instead of that, it can also be used for the purpose of speculation. Over here now we are going to have understanding of the concept of the stock index futures transaction which was introduced. Now let us think about a situation like this, that if a trader has long position on a well diversified portfolio for an amount of rupees 50 lakhs. He has long position means say he is holding shares. Well diversified portfolio means he is holding the number of shares which are belonging to the different sectors. And the amount of the investment is also huge. It is an amount of 50 lakhs. The trader is expecting fall in market price of the shares. In short, he is bearish. He is expecting that the price of the securities will fall down. If at all he is expecting that the price of the security will fall down, then in that case what he should do today to cover up this kind of loss that he is expecting to make in, let us say, next 3 months. Next 3 months is the time period in which he is expecting this kind of decline in the market value of the shares. One thing that may come apparently in your mind is that we can tell him that you sell your stock right now, and when the price of the securities fall down, at that time you purchase it. Simple. This is the way you can have a kind of like the transaction to be entered upon if you have this kind of expectation. But friends, practically this is not something that you can do. The first reason for that is a kind of transaction cost that you have to incur practically. When you sell the investment, at that time huge brokerage you have to pay right now, and later on if at all your expectation is fulfilled and you buy the stock, even at that time you have to pay the brokerage. So this is the first limitation that we have. The second important limitation that you have is this. Listen carefully. What happens at say, whatever is the current market price of the share, which you always see is the price at which you can sell only some of your shares. If at all I am holding, if at all 5,000 shares of the Reliance company, then those shares cannot be sold at the price which is prevailing right now of the Reliance company. All the shares cannot be sold at that price. I can sell a few shares, then the price declines. Again I can sell few shares, then the price declines. This is the way you will be able to get the read of the stock, and ultimately the value of the portfolio which you are going to receive will be substantially less than 50 lakhs. So practically this is not going to make a sense. Then in that case what you should do? Dear students, you can take help of the index futures transaction. You can take help of index futures transaction. Listen carefully. I am telling you solution first of all. And then I'll explain you how that solution is going to make a sense to you. The solution is you should enter into the transaction for SAIL index futures for the purpose of hedging your long position in the cash market. By entering into this transaction, how you will be able to hedge? Let us understand. Now, after 3 months, we understand that the market might have gone down, might have gone up, or it may remain stable. Okay, one of the three possibilities are there. The market may go down as per your expectation. It may go up against your expectation, and it may remain stable. Now your portfolio and index. We understand logically something like this, that if at all the market has gone down, then in that case your portfolio also has gone down, because your portfolio is say a kind of diversified portfolio. That is the reason, say if at all the market has gone down, then your portfolio has also gone down, and over here you will be incurring a loss. This is what we understand. Now, importantly, what happens that say you already have entered into the transaction for SAIL index futures. So if at all your portfolio has gone down, then the market has also gone down. At this point of time, you have entered into the transaction for SAIL index. Your portfolio has gone down, and in that case, we understand logically that the market must have gone down. If the market has gone down, then in that case, you will be able to purchase at the lower spot value and sell at predetermined higher value. And in that case, you will be able to compensate your loss, may not be entirely, then in that case, to some extent at least. That is the way you will be able to get the hedging. So we understand that say on, let us say, 1st of January for 31st of March, we already sold index, for example, at 3,40,000. After 3 months, so the market is falling down, then in that case at spot value 3 lakhs, I have to buy it for, and I will sell at predetermined value of 3,40,000. So I will be having say a profit which may not be sufficient to cover up the entire loss. It may be, and it may turn into the profit ultimately. We do not know. That depends upon case to case, but this will happen. If at all the market is going up against my expectation, then on my long position I will be able to make profit. And always there is a thumb rule that if at all you are making profit, then in that case you have to sacrifice your profit. Why? Because generally in this case you will be incurring a loss. Because your portfolio has gone up, then the market has also gone up. So you have to purchase at this value to sell at this value. And difference of that is the loss that you will be incurring. If the market is remaining stable, then in that case there is a marginal profit and marginal loss. This is what we understand. This is what the way you can have the hedging strategy. So what you should do, I am only explaining that. So you should enter into the transaction for SAIL index futures. In how many contracts you will enter upon is something that's now we are going to discuss. So write down heading. Before we understand the number of contracts, just a small note. Index futures, in bracket write down hedging tool. In that write down first point. So write down first point. Index futures transaction can be entered upon for the purpose of hedging. Full stop. Second point. Suppose a trader slash investor has made investment in a security slash portfolio, comma, is expecting decline in value of investment, in bracket write down bearish, full stop. He can enter into transaction in futures for hedging, full stop, if beta of portfolio is positive, comma, sale index futures, can be entered upon for hedging, full stop. Third point, suppose above contract is entered upon for 3 months, full stop. On expiry of 3 months, comma, trader will have usually one of the following position: market up, down, stable, portfolio, index, overall. profit, loss, overall maybe profit or loss, loss, profit, overall maybe profit or loss, marginal, over here not significant profit or loss. This is what say we will have. Now friends, over here I have dictated one thing to you, that beta of the portfolio is positive. Now this is what say we have a kind of CAPM in which we understand that say usually most of the securities will have positive beta. Positive beta is indicating that say the security of the portfolio will move in the same direction as the market. If at all the market is moving up, then usually all the securities are going up and vice versa. The logic behind that is that say any company will be able to have business when others are having business. There are very less companies or very few companies which have negative beta. Otherwise, generally, any of the company will have the business only if the others are there who can give business to that company. This is what say we have a kind of the usual trend. Now you may be having a point in your mind that sir, if at all the beta is negative, then what to do? We are going to discuss that later on. If at all the investor has short position, then we are going to discuss that later on. And such other the situations we are going to add. Right now I want to focus on a point which is most significant. Then we are going to add further that if at all a trader has long position in the cash market, beta of his investment is positive, he is expecting the market decline and he want to hedge. In this specific circumstances, what he should do? He should sell index futures. With that, we can see from this table that say he will be able to hedge. Now, what is the number of contracts is what now we are going to discuss. Now friends, before I proceed further, just say there is one formula of the portfolio management which I would like you to recall. One of the formula that say we have studied is like this. Beta is measuring what is the percentage change in RJ, that is return of my portfolio, for every 1% change in RM. What is the percentage change in RJ, that is written in my portfolio, for every 1% change in RM, that is written on the market portfolio. That is what the beta measures. In a way that say, suppose beta of an investment is 1.6 for example. Then in that case, it indicates that when the market return increases by 5%, then in that case return of my portfolio should increase by 1.6 into 5, that is 8%. And if at all the market return is, let us say, falling down by 10%, then the return of my portfolio will reduce by 16%. That is what we understand. So let us have understanding that say that how many contracts are required to be entered upon. Now to discuss that, I am taking help of say certain numericals. You don't have to write anything. Let us have a discussion of that first of all. Do not write anything. Consider following information. Current value of the portfolio is 5 lakhs. This is given a technical name as you have long position in cash market. Beta of your portfolio is 2. Futures index value is 1000. So that 1850 or 1700 something like that. Similar to that, it has been provided 1000. Lot size is 50. The example that we did previously in that it was 200. Similarly over here, so the 50 units something like that is given to us. The first question is what will be the percentage change in the value of your portfolio if the market return reduces by 10%? Friends, answer for this is very simple. It is 10 into 2, it will reduce by 20%. Now second question, what is the amount of the short position, not number of contracts, required in index futures trading if the market is likely to fall by 10%? So the question says that, say, if at all the market is likely to fall by 10%, what is the amount of the short position which is required? We can understand something like this. 5 lakhs into, understand it carefully, negative 10% into 2. This is the loss in my existing portfolio which I am expecting, and this loss I want to compensate with the futures trading. So I will enter into the transaction for X amount of the futures contract to be sold into negative 10%. I repeat it again. What happens, I'd say whatever the loss which I'm going to cover over here, that is I'm going to incur over here, that loss I want to cover up, so with the profit which I'm able to make over here. We understand that, say, when the market is falling down, only in that case my existing portfolio will fall down. So I should enter into the transaction for such amount of the futures, so that, say, when the market is falling down by 10%, it will be able to recover my 20% loss in existing portfolio. So I should enter into the transaction for X amount. So we understand that over here it is 5 lakhs into 20%, that comes to 1 lakh, or we can cancel this 10% from both the sides. So the answer is that X is equal to 10 lakhs. This is the amount of the short position for which I should enter upon. Okay, let us have further understanding like this. Let us say that, say, as per our expectation, the market is falling down by 10%. So what will happen? My portfolio and index, I have entered into the transaction for SAIL index future for an amount of 10 lakhs. Market is falling by 10%. So what happens, let's say I will purchase index for rupees 9 lakhs. Why? Because so the market has fallen down by 10%. So 10 lakhs minus 10%. Now my portfolio had a value of 5 lakhs. Now it will reduce by 20%. Why? Because we understand that, so the market has fall down by 10%. So the revised value will be 5 lakhs minus 20%. So it will be 4 lakhs. So whatever the loss that I have from my existing portfolio of 1 lakh will be compensated with the profit in the index by rupees 1 lakh. So friends, I am giving explanation once again, that what happens that, say, I have entered into the transaction for SAIL index for an amount of 10 lakhs. The market is falling down by 10%, so it reduces to 9 lakhs. So I make a profit of rupees 1 lakh. When the market is falling down by 10%, value of my investment falls down by 20%. So 5 lakhs minus 20% is 4 lakhs. Value of my portfolio was initially 5 lakhs. So there is a loss of 1 lakh. This profit is able to recover the loss. So now this formula that, say, we understand is like this. 5 lakhs into 20%. Why? Because I am expecting the loss of 20% in my portfolio. This should be recovered with the index trading. So in index, what is the amount of the profit that I should be able to make is equal to this amount of loss. So X is the amount for which the futures transaction has been entered upon into negative 10%. Why? Because whatever the future index value is prevailing right now, that I will sell, and that I will sell for such an amount so that it will be able to recover the loss which I have right now. So we understand that say this is the way the amount of the futures contract can be calculated. Now the next question is, do not write anything, let us have understanding. How many futures contracts should be sold? That is the question. We understand that so the 10 lakhs is the amount. Over here, the futures index value is provided to us as 1000 and lot size is provided as 50. So if at all you enter into one contract, it is like 1000 into 50. So 50,000 rupees is the amount for which the futures contract is sold. You want to sell index for 10 lakhs. So you have to enter into 20 contracts. This is what we understand. Suppose friends, suppose that this lot size is 60. So that is suppose for example. Then it would be 60,000. And 10 lakhs upon 60,000. That comes to 16.67 contracts. We cannot enter into the fraction number of contracts, otherwise the lot size does not make a sense. In that case, you can enter into 16 contracts or 17 contracts. That is the way the number of contracts that can be entered upon, and accordingly, say this profit or loss will be calculated. So we understand that say this is the way the number of contracts are required to be entered upon. Do not write anything, let us have further understanding. Let us have understanding. Consider following information. Current value of the portfolio is 5 lakhs. Beta is 3, futures index value is 1000, lot size is 50. What will be the percentage change in the value of the portfolio if the market reduces by 10%? So we understand that it is 3 into 10, that comes to negative 30%. So the when market is reducing by 10%, over here, so there will be a reduction by 30%. What is the amount of the short position required if the index futures trading, in index futures trading, if the market is expected to fall by any percentage? We understand that so the answer is like this: 5 lakhs into 3 is equal to X. Simple. Because we understand that say over here negative 10%, negative 10%. That is always going to remain same. So you may write it, you may not write it. So the X will be calculated as 15 lakhs. So we understand that say the amount of the short position required is an amount of 15 lakhs. So logically we understand once again like this, that portfolio and index. Understand carefully. Sale value, purchase value, profit loss. What is the existing portfolio value? 5 lakhs. Now suppose the market is declining by 5, that is say by 10%. This reduces by 30%. So 5 lakhs minus 30%. This reduces to 3,50,000. So you incur a loss of 1,50,000. You already have entered into the transaction for sale index. How much? 15 lakhs. Now the market is declining by 10%. This is 13,50,000. So this profit of 1,50,000 will be able to compensate the loss, and overall you will be having say the zero profit or loss. How many futures contract are to be sold? That's very simple. It is 1000 into 50, that comes to 50,000. So 15 lakhs upon 50,000. So 30 contracts are required to be sold. This is what we understand. Let us have further only a discussion. Consider following information. Current value is 5 lakhs, beta is 2, index is this. What is the amount of the short position required in index futures so that beta of the portfolio reduces to 1.5 if the market is likely to fall by any percentage. So this question is quite different from the earlier questions that we did. The question says that say I want to partially hedge my portfolio. I do not want to have the complete hedging. So we understand something like this. Can we say that say loss in my portfolio should be covered up with the profit in index? So 5 lakhs into whatever the loss percentage, negative 10% which is given to us, into, can we say that say 2 minus 1.5? I want to reduce my risk only to the extent of 25% is equal to x into negative 10%. So again this negative 10 is cancelled. So I should enter into the amount of the futures contract hedging equal to x is equal to 5 lakhs into 0.5, that comes to 2,50,000. So I should enter into the futures contract hedging only for 2,50,000. If at all I want to reduce my beta to 1.5, so I'll get the partial hedging. This is what the concept says. I am not satisfied with this. Let me check portfolio and index. I enter into the sale, buy. Enter into the transaction for sale of 2,50,000. Market is falling down by 10%. So over here it reduces to 2,25,000. So I make a profit of 25,000. Value of my portfolio was 5 lakhs. Okay, the long position in the spot market 5 lakhs. Market is falling down, so my portfolio will also fall down. 5 lakhs into negative 10% into 2, it will reduce by 20%. So it will reduce to 4 lakhs. So I am incurring a loss of 1 lakh. Overall there is a loss of 75,000. Okay. So on my existing portfolio, I incur loss of rupees 75,000. My portfolio was having a value of 5 lakhs. So there is a loss which I am incurring as 75,000 divided by 5 lakhs into 100. So it is negative 15% is the loss which I am incurring. We know that beta is percentage change in RJ divided by percentage change in RM. So in fact what happens at when market is falling down by 10%, overall my portfolio is having a loss of 15%. So in fact I am able to have the beta of 1.5 which I wanted to have. This is the way we understand at the 5 contracts, that is 2,50,000. In short, it is 5 contracts, is the number of contracts in which I should enter upon. And this is the same question that we did earlier. It is the same question that I did over here. In that, the answer was how many contracts? 20 contracts. So 20 contracts for complete hedging. That is, say from beta 2, I wanted to reduce to 0, no risk. Then in that case, you sell 20 contracts. But now from 2 beta, you want to have beta 1.5, means you want to have hedging of 25%. So 20 into 25%, you get the answer 5. And that is the way you will be able to have the partial hedging if you want. So over here friends, we understand that the amount for which the futures contract is entered upon. For that, say, can we say that something like this? It is value of the portfolio, that is 5 lakhs into beta of the portfolio minus beta required. If nothing is given, then the beta required is 0. You want to have complete hedging. In absence of any information, we assume that say you require complete hedging, then the beta required will be 0. And if at all you want to have a partial hedging, then in that case we will mention the beta that you require. So this is the way we can compute the value of the X, that is the number of contracts, divided by futures index value into lot size, that is the amount divided by the futures contract value for one contract. This will give us the number of contracts that can be entered upon. So friends, let us continue with the discussion that say we had. In that, say, now new heading, that is over here. So this note that we have written, in that, say, the fourth point, write down formula for number of contracts to be sold. In that, write down VP, that is value of the portfolio, into BP, that is beta of the portfolio, minus beta required, divided by futures index value into lot size. This is the formula that we have. Whatever the numericals that I have explained to you, like just orally, we are going to write them one by one. VP stands for value of portfolio. BP stands for beta of portfolio. FIV stands for futures index value. Fifth point, in case beta required is not given, comma, we assume that it is 0.